Hi, I'm Keith McCullough, and welcome back to day 3 of the Investing Summit. A little timely. We called up the market gods and got some stuff going on out there. There is a saying in macro that when you call Europe, who do you call? Okay, everybody's talking about the crazy guy you call at the Fed now here in the US, but when I call Europe, I call Daniel Lacalle. So welcome, and it's always nice to have you. I know that everybody who's familiar with our platform and who we deem to be the people that know what's actually going on and can actually translate the economic outlook to the market outlook, which is unique. Obviously, you have to be well versed in both. You've worked both in the hedge fund industry and also published plenty thought-leading academic books, reports, etc. So I know you're the guy, and I think a lot of other people do too. So let's just kind of like jump into it, Daniel, and just give like your top-down view of why Europe's slowing and whether or not it's still a big risk.
Well, thank you first very much. Thanks for having me here. Always a pleasure to talk a little bit about markets and the economy. And I think that what is happening in Europe should actually not be a surprise to anyone. It's called fundamentals. No? The European slowdown has been there for now, 8 months. 8 months of solid slowdown data. And comes from very evident sources. You have debt saturation, you have a very high level of government spending that detracts from the productive sectors, and at the same time, you have the demographic challenge and also the overcapacity challenge. So the European Union continues to have a problem of excess capacity. So what we had for a while was the mirage of exceptional growth, of the idea that Europe could be growing 2.3, 2.4%, which you and I have talked a few times about. It was completely based on nothing, on literally nothing. Even if you look at the corporate sector, if you look at the household sector, if you look at the public sector, the European Union could not be posting the levels of growth that consensus was showing, 2.3, 2.4%. So what is happening right now is simply the evidence of that. Nothing worse, nothing better, just the evidence of an economic zone that is actually comfortable with stagnation. Mm-hmm. And the reason why it's comfortable with stagnation is because the paramount pillar of policy is government spending. And once that you understand that government spending and entitlements and the public sector are the key components of the economic policy of the European Union and the Eurozone governments themselves, then it is very logical that we have this slowdown and these challenges in both the equity and the bond markets.
It's again not shocking that the socialist economies of Europe are still left-leaning socialists that are highly dependent on government spending. I think most people that have gotten Europe right got that right. Effectively, what you're saying is that it is still Europe. I mean, in the U.S., there's a football coach called Dennis Green would say they are who we thought they were. So at the end of the day, to me, that's actually the most interesting point on what comes next. Is it predictable or not what their response is going to be? Italy today, as you know, moved into crash mode. We define a crash as greater than 20% in a stock market move from its prior high from May. If it was only in May, never mind Spain having gone down for a year and a half now from its highs in 2017. Italy's down that much since May. Greece down 30% since January. People are like, Keith, why are you looking at the Greek stock market? It's like last time were you looking at anything in Greece? So is it predictable or not what the monetary and government response will be to the next European and ongoing slowdown?
I think it is quite predictable with 2 or 3 degrees of separation, but it is quite predictable because think about this. Everybody in the bond market understands that Eurozone sovereign yields are completely abnormal and totally detached from reality, right. Of the reality of risk and the reality of solvency. Everybody understands that. Everybody understands that, for example, you were mentioning Italy. In Italy, the only buyer of sovereign bonds in the last months has been the European Central Bank. So once you understand that that bubble cannot be pricked, and that the European Central Bank needs to continue to do operation twist, TLTROs, kind of different options to maintain those yields low, then you know that the illness will be shown in other symptoms. And those symptoms are the equity markets. And equity markets have been showing actually the reality of risk in Europe much better, obviously, than a bond yield, than the bond yields, particularly of sovereigns, that have been artificially suppressed.
Right.
If you think about but then comes the next phase, and that's why Italy is crashing, is that first you have the symptom of the equity market, and people continue to say Europe is cheap, Europe is cheap. Europe is always cheap. It's cheap for a reason. Cheap. It's always cheap.
Cheap and getting cheaper.
Reason. You have the same industrial conglomerates with no growth, no total shareholder return policy, and no management incentives to drive the stock higher. So obviously that is going to continue to be, a multiple depressing stock market. But high yield interests me, because on one side everybody understood that sovereign yields were abnormal. On the other hand, you could have some sort of debate about whether Europe was cheap or whether this time was different or not. But at the same time, you had the real bubble in high yield corporates in the Eurozone, with about 260 basic points over the sovereign. So the sovereign is at artificial low yields. You have already a very low spread over the sovereign. So high yield in Europe was phenomenally expensive, while at the same time the number of zombie companies, according to the Bank of International Settlements, was soaring in the European Union. Low rates, basically you perpetuate, zombify the economy by constantly refinancing the lowest productivity sectors. So I think that is the challenge. Can it be predicted? Yes, you can predict that the European Central Bank policy is going to err on the side of doing whatever so that the pain is the lowest.
Yeah, I mean, in the U.S., it's an interesting one. Like, as you know, I go door to door, like mutual funds, hedge funds, pension funds, and a lot of people, are invested in credit. And what they've done over the years, particularly in the hedge fund industry, is that they've built credit teams and credit departments. And of course, the credit, because we're at all-time tights in the U.S., they had to go elsewhere, so they buy Brazilian credit, Argentine credit, European credit. If it says credit, they'll buy it. Now, they always ask me, Daniel, they always say, okay, well, what's the imbalance in the market? I'm like, are you blind? I mean, the imbalance is the buy side's ownership of speculative credit. Now, how big is that in Europe? In the U.S., obviously, there's $2 trillion in triple B paper and alleged triple B paper. What is it in Europe that, like, you look at every day as a proxy for this, or where do you see the big potholes on European credit, high yield?
I think that both sides. No, on one side the sovereign credit, and on the other side the high yield, alleged high yield. No? You cannot call high yield when you pay 4% for a company, when you get 4% on a company that is almost bankrupt. So that is very low yield. But the point, so it's, if you think about it, currently there's about $6.5 trillion of negative yield in bonds globally. No. Most of that is between Japan and Europe.
Right.
If you add not negative yielding in nominal terms, but negative yielding in terms of the risk return ratio that you should attach to those bonds, you have almost $7 trillion of high risk credit in the Eurozone alone. Huge, huge. Because on top of that, think about this. Almost all of the concerted efforts of the Eurozone countries have been to prevent the European Central Bank from taking measures that would force the banks to take action against these sort of non-performing loans. No, so you have on one side about almost $1 trillion of non-performing loans plus the sovereign problem.
Yep.
I think it's quite a challenge. It is definitely a challenge because again, the European Central Bank will have to err on the side of caution. Therefore, it will not have tools to address the next economic cycle turn. And so instead of solving at least partially the risk problem, where it is simply perpetuating, no?
Mm-hmm. I mean, that makes, and I want to get to like your view that they won't be able to solve for it this time. But first, I just want to like finish on this point on the debt and the size of the debt and the speculative nature of the debt. You've been very clear on this. I think you're the first person to call it that. There was a play on words. I think you called it the globally synchronized, growth in debt. Now, now a lot of people came into the year saying, "Oh, we have a globally synchronized recovery," and whatever. If I was in London, I might sound intelligent saying it that way, but it's not a smart thing to say anymore. We don't have a globally synchronized recovery. We have massive divergences. We have China, EM, and Europe slowing, and USA we think about to slow. But on top of it, that synchronized debt. What do you mean by that, and how big and how big of an issue is this going to be?
It is, to me, it is the biggest concern in the market, because think about this. Let's start when the Fed begins to, when the Fed announces its tapering and you have the taper tantrum. The taper tantrum, instead of being a yellow card that sends investors to be a little bit more cautious and governments more cautious, was almost like a green light for governments to massively increase their debt and massively increase their imbalances. No? Mm-hmm. So one of the, in my opinion, biggest risks was that instead of using the period in which everybody was announcing that you would have a lower level of liquidity and that interest rates would gradually increase, what happened was that emerging markets and corporate and Eurozone as well, corporates decided to take a lot more risk, increase debt, no? Mm-hmm. The level of debt in dollars of emerging markets went from 30% of GDP to 41% of GDP in only 3 years, led by China in particular, but also other countries. So what happens now is that what you have in front of you is a situation in which it is virtually impossible to take corrective actions against these imbalances. Because if you look at the estimates of fiscal deficits and trade deficits that are assumed by consensus for the next 3 years, most of these economies are going to continue to increase debt, and we're already at 325% of GDP.
I mean, this kind of picks up on what Jim Rickards was saying yesterday. I mean, there's plenty of academic work, and all we mean by that is studying history, that suggests that once you get to that 90 to 100% plus debt to GDP ratio, and you're running a deficit, and then you layer on a slowdown cyclically on top of that economy, kaboom. I mean, that's basically what happens. You can't, the central banker is in a very tough position, almost, dare I say, pushing on a string like 2008. Is that what you mean by the response this time? The central banks are not going to be able to solve for the crisis or the turmoil or whatever the heck you want to call it?
Yeah, my point with the next phase of the economic cycle and what central banks can and cannot do is similar. Think about a stock now in which the company itself buys every year 10% of the market cap in buybacks. No, it becomes part of the liquidity. It becomes part of the liquidity, so it doesn't necessarily mean that it will support multiple expansion and increase in value. No, it is simply part of the liquidity. So the market gets used to it. So once the central banks are, as they are today as we speak, increasing the size of their balance sheet by about 23 billion a month. No, what you have to do basically is to give a signal to the economy that things are getting better. If central banks now decide to unwind their normalization policy and decide to err on the side of caution, the message that they are sending to the investment community is, guys, we know something that is much worse than what you think. And as such, the additional liquidity or the lower rates that you try to implement have absolutely no effect. It's basically the law of diminishing returns. You put 20 trillion into the economy, you generate a little bit of growth. You put 22, you're not going to generate an incremental level. But once you are at zero interest rates, then on top of not creating any growth, you're actually incentivizing malinvestment. So you have a double whammy. You have a double whammy of risk on top of risk that makes it a lot more complicated.
Mm-hmm. I mean, it's what makes it even more complicated is waking up in the morning. Actually, and thank you for this, because given that we're all going to be accused of being crazy at this point, and I am certifiably crazy when it comes to analyzing macro markets, I'm fully aware of that. I see on my Twitter stream the reporting of economic news in the world is just purely turned into a macro tourist event every single day. And I got this one guy, Daniel Lacalle, there, and thank God you're in Europe or London or wherever you are on a time horizon that can contribute something to the dialogue. People blame everything that's going on, as you know, on Trump, tariffs, trade, Trump, tariffs, trade, tariffs, Trump, whatever they want to say. It's all in their political mind. It's all within their narrative. What do you think about that relative to this thing that you and I have spent our whole careers, 20 plus years at this point studying, which is the economic cycle?
Yeah, well, it's think about this from the perspective of consensus. It's the easy way out. It's the easy sort of excuse. No? What you're saying basically is this is all due to Trump and tariffs, not due to incorrect analysis or being overly optimistic or the fact that we were completely wrong. No, obviously it's not. I mean, the if it was for trade wars, we've been on a trade war since 2001. We've seen, you and I have seen tariffs on steel, tariffs on solar panels, tariffs everywhere. We have been seeing increase in protectionist measures since 2001. Between 2001 and 2016, we saw more protectionist measures from the G8 countries than in the 50 years before. So imagine. So the issue is to find a scapegoat, is to find an excuse, isn't it? And that leads to making wrong investment decisions. When you blame it on an external enemy is when you make wrong investment decisions, which is what happened in the Eurozone when they blamed everything on the evil Lehman Brothers and the US banks that were crazy. But the Eurozone had the best banks and the most regulated ones, and it was fantastic, no? And there you go, 8 years later. So what we need, there are numerous factors that are contributing to the slowdown, but the biggest one is that a new unit of debt globally is generating a lower level of growth every time. So the allegedly positive side effect of demand side policies is actually becoming the opposite. It's actually becoming a negative, no, and it's generating negative returns. The other point, obviously, is that we place, as analysts and as investors, we place an abnormal level of, I would say, faith on demand side policies. So when a central bank increases money supply or lowers rate, we immediately, or the consensus immediately assumes very high levels of growth because of that, very high levels of improvement in investment, etc. And it's, and it's complete rubbish. But and at the same time, we place absolutely no faith on supplier side measures. This is fantastic. That's why the US is surprising this year to the upside, and that's why the rest of the world is surprising to the downside. And it's as simple or as complicated as that.
Yeah, well, sometimes you have to simplify the complex by just using that damn data. And again, the historical time series predicted, again, the slowdown in China, because you never had an acceleration that was stimulated like ever before in China. You start with that, and then you continue to flow through. If it wasn't different this time in Europe, They were going to slow cyclically anyway. And you layer on your views of debt, and this gets a lot scarier than I can scare people. I'm not trying to scare people. I'm just trying to tell people the truth, because most mornings they wake up to somebody's version of their own political truth, which is pretty much useless, according to me at least. Maybe a good spot, we got a bunch of questions here, Daniel, if you don't mind. I can get some of the audience to ask you what they really want to ask you. I think Daryl Jones will probably chime in.
Absolutely.
Yeah, I have some great questions here. We've touched on some of this, but I think some of it's worth going over again as well. Daniel and Keith, is there still big blow-up risk in China considering they're accumulating all this debt?
My opinion on China is that the bearish argument on China is not crash, it's stagnation. Yeah. This is what people don't understand, is this is a centrally planned economy. The government is not going to let the economy collapse in a sort of, Western world type of view. It has capital controls. It has massive money supply intervention. The government and the central bank are one and the same. And this is the issue I have with the people that say, well, you're wrong on China because China is growing 6%. Well, no. First, no. Look at the numbers and see that in reality what you're having is a constant bailout of the least productive sectors by the PBOC, while at the same time you have the shrinking of the additional level of growth that you get from the stimulus. And obviously China would not be doing swimmingly if when the government needs to lower taxes massively, increase brutally the level of injections into the economy, and can constantly bail out the banks, obviously. So I think that is the difference. Is when you look at China, don't think about it from the perspective of a crash in the way that we think, say, Greece or Argentina. Think about it of a Japanese stagnation that leads to China growing in real terms way below inflation in the next 10, 12 years.
Yeah, that's mathematically speaking, that's a very easy thing to see. Any economic stagnation in China. I'll just give people like a quick review of China, like in a couple slides. Slide 115, guys, if you can throw the slide deck up. And Daniel and I talk about this. I mean, most people that are fundamentally aware that aren't macro tourists understand this, obviously. But this is what happened. It's called the Shanghai Accord. So in 2015 through 16, what the Fed did was that's the Fed's dot plot on the left side of the chart. They're devaluing the dollar. They're going dovish. Janet's freaking out. And on the right side, you see the biggest monetary stimulus in the history of China. For those of you who read anything about the history of China, that's a very long time ago. Okay. Next slide. When they stimulated, what happened? These are the global economic, time series of global corporate profits, global manufacturing. We're talking about one of the greatest accelerations from point to point, from a recession in cyclical industries to an expansion, ahead of Xi being elected for life. Next chart, you can see if you separate Chinese GDP growth into the three buckets, i.e. take out the bucket that they make up and lie about, which is the main bucket, the headline, and you look at the red one, which is the one they command and control. As Daniel pointed out, they're communists, they're a centrally planned economy, they command and control secondary industries, heavy industry, empty cities, construction. That red line went to 0% growth in 16, magically goes to 15% growth by the end of 17, and that equated to 50% almost of Chinese GDP growth. And we're talking about the biggest engine of growth in the modern era. Okay, final chart is just to show what Daniel's view is any economic stagnation. Okay, so the black bars are what the Chinese have to compare against. This is called the base effect. You have to compare against going from an 8 to a 9 to an 11 to a 12 in the next 3 quarters in percentage terms on a 2-year stack. If you don't know how to model that, I can help you with that later on. The point is that China's going to slow anyway. It doesn't matter what Trump's going to do, what he's going to tweet. There is absolutely nothing that the Chinese can do to cycle against what they already did to resuscitate the global economy to the beloved globally synchronized recovery that everybody started the year with. Okay, so this is our answer on this. I can tell you, Daniel, we do business with inside of 500 institutions. There are many more institutional money managers out there than that, and I'd say my hit rate on this one is about 75 to 80%. That's very high.
Sure.
That people, once they see that, they remind themselves of that and they go, oh my God. That's the only response I get. Nobody disagrees with me on it.
Completely. No, I understand completely because it shows the extent of how much debt and how much stimulus the Chinese economy needs to generate 1 unit of real GDP. More importantly, a single unit of economic added value, which is what matters at the end. GDP is certainly sort of easy to manage in a certain way. But it's something that people tend to misunderstand. Is that I remember a couple of weeks ago, last week's data, that some people were saying, well, look, the data in China is very strong. And I said, did you see the ratio of money supply growth required to achieve that data? Because it's insane. And that ends up always. By the way, this is the only thing is to understand the timing. But when you have countries in which money supply growth is twice, 3 times real GDP, it ends up always either with a short crisis and economic turmoil, or with stagnation.
All right, another question here for you guys. What countries in Europe are the most at risk from an economic slowdown perspective? And then conversely, what countries are best positioned? So
well, in the Eurozone right now, you have the ones that are the biggest risk are, funnily enough, very few people talk about France, but France continues to be in stagnation mode after 2 decades, and despite the initial strong reaction to the election of Mr. Macron. His popularity now is at the lowest I've seen in a president for many, many years, 20%. Everybody talks about Trump in the United States. You have Macron at 20%, and people think that Macron is like, I don't know, an angel. So France is a big challenge. It's a big challenge because France never took austerity measures and never made drastic reforms. And because of his lack of popularity and the loss in number of ministers, Macron's, let's say, push for those reforms that so many people were expecting are not happening. So France is on the weak side. Italy is impossible. Italy is impossible because Italy is you have a government right now that is looking to do exactly what has led to the disaster that the economy was, to subsidize even more the unproductive sectors and increase spending and, the historical problem. So where are the growth drivers? Germany, with all of the challenges that it has with trade and its massive and its too large trade surplus, etc., Germany is sort of okay. I think that the Netherlands are also, Holland is doing well. I think that Ireland is also working okay. So the growth drivers, if you look at the countries that are showing a positive economic surprise, are actually more on the smaller countries. The ones that continue to be a challenge are Italy, Spain, France, and obviously Belgium.
Yeah, what's interesting, talk about a smaller country that doesn't look like it's very healthy right now from an equity market or risk perspective is Denmark. I wondered what your thoughts were, because we're talking about the instability of debt, the system, central bankers having an ability to control it. And here we have this massive money laundering Ponzi scheme or something like this in Denmark this week, and the stock market just got crushed. What's going on there?
Well, I think that the Danish are not used to thinking that something like that can happen in the
evidently. Yeah.
Wow. And it generates a shock for a country that is sort of proud to be and probably in some senses rightly so, a model in terms of governance and a model in terms of, let's say, management of the economy. But I would say that the big challenges of Denmark are pretty much the same ones that we're seeing, for example, in Sweden and that we're seeing in Finland, is that the whole economy is based on a very aggressive welfare state. And there is a point in which let's say that the thin line between the productive and the subsidized sectors starts to move uncomfortably to the subsidized ones.
Yeah.
And therefore the sustainability and the solvency of the system start to crack. No.
Yeah.
I don't think that it is a drastic situation, but I think that what we are seeing is sort of that mirage of the Nordic countries being at least unveiled a little bit.
Yeah, that mirage of the, I guess it was a Swedish experiment. It lasted a very short period of time on having a living wage. I mean, that was, if that isn't the manifestation of socialist policy, I don't know what is.
Finland was a disaster. Finland had a universal basic income experiment that was only applied to a very small number of families, and it was very controlled. It was because the government wasn't very sure about it, and it was done as an experiment, and they had to cancel it. They had to cancel it because suddenly, what was this is unbelievable is that in a country that is so proud about its public sector and about being responsible with public finances, etc., and not sort of cheating the system and living off entitlements, how quickly people started to, let's say, decide to not go to a job interview, or how quickly they started to decide not to apply for a job. So the experiment was sort of closed, and
The ideas socialists come up with, I mean, you and I are a lot of things. I got a lot of issues, but I'm not a socialist. I'm happy for that.
I'm so far away from that.
All right, we've got a few more questions here. Next one. Should we be bullish on European sovereign bonds from here?
No.
Okay.
No, not at all. At best, what the European Central Bank will do is to maintain sovereign bond yields as low as it can. But it cannot do magic, no? It cannot do magic forever. He can do an operation twist, it can reduce, but credit default spreads are already starting to move, grinding higher. Secondly, if you and I believe that interest rates are going to go up despite what central banks do, that risk perception starts to creep up in the economy, and that you're not going to be paying 6%, accepting 6% for the bonds of a country at war and things like that. Then the pile of negative yielding bonds is a very dangerous threat. So I would say the only thing is, if you think, that is not my case, the case that I see at all, by the way. But if some people think that there is a risk to the euro, then obviously buy German bonds like there's no tomorrow, no? Because if they get redenominated in Deutschmarks, you're going to make so much money, it's out of control. But that is not my base scenario. I don't see it at all. Not even the Italian government with a populist coalition is aiming for that. But I would say be very cautious, because it doesn't make any sense. If you look at the list of sovereign bonds in the Eurozone right now, you have to go to the Greek 10-year bond gives you 4% and change. Okay, you tell me if that is a risk-reward scenario that you want to accept, considering a case in which the ECB keeps a very accommodative monetary policy, but is not able to sort of bring yields as low as they have been in the past 2 years.
Mm-hmm. It's amazing to watch. I mean, you have so many people that that disagree with us on this. I mean, it's like they automatically equate risk to, well, bond yields got to blow up, the sovereign's got to blow up. And it's been quite the opposite, obviously. I think if they study the Japanese government bond, which is probably the greatest security in the history of government securities, it only goes up and has no vol. People just, for as long as people have analyzed macro markets, have fought this relative value game of why a German bond shouldn't be at 50 beeps on the 10-year because another 10-year is at a different level. That relative value game has really crushed people on the bearish side of German bonds, Swiss bonds, Japanese government bonds. Do you think that anything is going to change on that stuff, or are you just saying pretty much what I'm saying?
No, absolutely agree with you. No, think about this. Everyone that's listening or watching us right now, what government, what country, what currency do you want to work for? A strong currency or a weak currency? Okay. Okay. So now that you have only one currency and it's the euro, therefore you have to decide on what you want is to work for a strong government or for a weak government. Okay, because the weak government is going to pass the imbalance to you as a saver and to you as a salary receiver. No? Mm-hmm. Again, as you make that analysis, the let's say that the list of options of where you want to invest in terms of bonds in the Eurozone lowers dramatically. No, lowers dramatically, and you have to be very, very cautious about governments that actually don't see their problem of imbalances as a problem of what they're doing, but a problem of you saving too much. Mm-hmm. And wherever that you hear, and they're very bright, very, very famous academics all over the Eurozone and in Japan saying that the problem is that there are too many savings, run away. As a bond investor.
No, it's like if you're that freaked out, and you and I can get people adequately freaked out by just talking about the cycle. That's what the cycle does. It freaks you out when it slows. But if you're that freaked out, why don't you put your money on the short side of a currency, whether it be emerging market currency or the euro for that matter? Why don't you short the stock markets in these countries? Why don't you short, to your point earlier on, the most speculative parts of high yield credit or junk? Why do you have to waste all your time and academic energy trying to say that the German bond yield should go from 50 basis points to 100 basis points on the 10-year?
Absolutely.
And it's like, if it does, by the way, all those other shorts that I just gave you are going to absolutely crash and burn to the ground. So it's to me.
That is actually a very good point. Because in the last 8 years, we as investors and as analysts have been focusing all the time in how to follow the trend that central banks were leading. We focus on the incremental 50 bips on one side without thinking about the tremendous return that you get simply by, and not by having a very, let's say, aggressive or super negative view of the economy, simply about thinking about slowdown and earnings growth coming down. That you have a much better risk return on the other side of the trade. But that is because we get used to being told that being short is going to be very, very bad for you because it's going to generate massive losses once central banks go crazy.
Yeah.
Well, guess what? Look at Japan this year. I don't know any central bank that is buying more bonds and more equities. They're buying everything. They're the top 10 shareholder on most of the Nikkei, and they're buying equities, they're buying bonds, and there you have the topics, and there you have the Nikkei. You don't even have to. There's a point at which I come back to the point that central bank action becomes part of the liquidity, and therefore you're all the time looking at the marginal up cycle part of the risk system instead of looking at the marginal down cycle of the risk system, and that's why you miss things like Argentina or like Turkey.
Yeah. Maybe one more, Darryl?
Yeah, last question here. In a globally synchronized slowdown, where should investors hide?
Funnily enough, in the most expensive lowest risk assets. No, what is already happening is you're seeing that what I call the sudden stop, no? Money that went massively into emerging markets, into the Eurozone, etc., looking for growth, yield, or a little bit of inflation, goes back to the US 10-year, no? To the German Bund. It's all a relative game at the end. And if you have a global slowdown in which trade and fiscal deficits are something that governments are at least unable to control, if not unwilling to do it, then it is the currencies that are going to be, let's say, the fever that shows the extent of the problem. No, mm-hmm. So obviously there. I mean, it's going to be very difficult to have an environment in which the Chinese are devaluing the yuan, everybody else is letting their currencies depreciate because they need to keep their foreign currency reserves at a minimum level to pay down their foreign exchange debt, and think that the dollar is not going to strengthen in that scenario, no? But again, there are growth stories. Remember that we are talking about the weakness of the Eurozone stocks from a perspective of the large indices. But there are stocks there in Europe that have done phenomenally well. They're up 10, 12% on the year. And disruptive technologies will continue to play an important role in driving multiples higher. I'm not saying that you have to follow the trend, but you have to sort of, let's say, it is easier to look at opportunities in developed markets, in what I call the renegades, no, in the companies that did not invest aggressively, that did not decide to go crazy on debt because interest rates were low, that decided not to expand all over the world. There's plenty of that out there. I think that I would not see it sort of a black or white type of situation.
Yeah, especially in the last 3 days, for people who didn't understand that concept of safe havens and paying up for premium safety and liquidity. That's what happens in what we call the fourth quadrant. And I think more people probably believe that today than they did yesterday. If you go back to maybe 9 months ago, people might have answered Daryl's question saying, oh, you go to cryptocurrency. That's where you go when the world, doesn't trust anything anymore. I mean, that was a load of what. So at the end of the day, here we are. Crypto, by the way, is also another illiquid position that people own with leverage, and that's collapsing. So it's interesting to watch, but it's certainly it's nice to have somebody who's as crazy as me, at least on the same page. We really appreciate you taking the time. The questions were good, and your answers were even better. So thanks for spending some time at the Investing Summit today. We appreciate it.
Oh, for me, it was an absolute pleasure. Always great to have a chat with you guys and with the audience. And let's continue the dialogue. It is going to be a lot of fun, as it always is, in the next couple of years.
Yeah, next couple of years. Bear markets are more fun. You and I know that. That's where we have a lot of fun. Appreciate that.
We used to say that longs are business, shorts are pleasure.
Exactly. But, speaking of shorts, like up next I have everybody's favorite short at Hedgeye. Tesla. Oh, yeah.
Oh, my gosh.
Oh, God. Oh, boy.
And by the way, congratulations on that call, because not only it is this is something that I mentioned to my students very recently about you guys. You have saved so much money to people that invest, $10,000, $5,000 in a couple of stocks, young people, students, etc., that were sort of phased by, amazed by the mirage of the Tesla thing, that I sent so much of your stuff to my students that I would save them a lot of money. So great call on that one.
Well, that's awesome. We appreciate that. We're always trying to help people. We're not the bad guys. We're trying to save some people some money.